What impact does credit have on the interest rate if you are trying to buy a home?
Well, credit has a bit of a domino effect on the interest rate. First, a creditor is going to look at, or a lender is going to look at risk primarily. So they're going to use your credit report and your credit score to determine if they believe that you're high risk or low risk. And if you're high risk, that's going to result in a higher interest rate. And if you're low risk, it'll result in a lower interest rate. And then that in turn will affect just how much you will be able to borrow, because the payment on a mortgage that's $500,000 at 5%, it's very different than a payment at 7%. So it's going to, if you have a higher interest rate, it's going to reduce the amount that a lender will lend to you.
Okay, that makes a lot of sense. Now we're talking about home buyers. What about renters? Does the interest rate affect renters at all?
Renters really just previously in the last year, or recently in the last year, have really felt the pinch of an increase in rental prices. And that is ultimately a result of landlords having to renew mortgages at a higher interest rate. And then they pass that cost on. The other big part is the cost of maintenance has increased. And again, a landlord will pass that expense on to renter. So they're feeling it right now, especially in Alberta. It's going up very quickly.
That's right. We've certainly heard a lot about rent increases, that's for sure. Well, tell us something. We're talking about people who are potentially jumping into the real estate market. What about current homeowners? How does the interest rate affect them?
Current homeowners, if you've renewed in the last year and a half or are on a variable interest rate, you felt it already. You've noticed a big spike as the Bank of Canada increased interest rates. And homeowners that we know, we have a huge number of mortgages that are ready for renewal in the next 2.5 years. They're going to feel the change. You know, like I said, it's a significant amount. A 1% interest rate change can result in hundreds of dollars a month in your mortgage payment. That's purely interest. So homeowners are going to have to sort of gear up and get ready for a bit of a change. They can start to adjust their cash flow now to get ready for something, because the days of 1% and 2% interest rates are probably long behind us.
Yeah, I think you're right about that. Well, you're talking about adjusting, the way we go about things. What is the process to get pre-approved for that mortgage?
So to get a pre-approval for a mortgage, before you go look for a home, you'd find a mortgage specialist, and that can either be at your institution or an independent mortgage broker. And what they do is they take a bit of a high-level snapshot. So a pre-approval is just that. You're not approved, it's not guaranteed, but they're going to be looking at things like your income and your debt and the relationship you have between those two. What is the ratio of debt to income? How much debt do you service each month, or what is your minimum payments? They're going to be looking at your credit score, your credit report. Do you have anything outstanding with the CRA? And they're going to do kind of a high-level snapshot to give you an idea of what they believe you would be approved for and at what rate.
Okay, so once you get that number, you're pre-approved for X amount of money, and it may sound like a lot. What happens then?
Well, you get to celebrate a little bit. That's an exciting first step.
Yeah.
And then you look for a home. But, there's a little bit of a caveat there from the financial counselor's perspective, and I would agree with, or I would imagine that a mortgage broker would agree with me. First is a bit of a warning. Don't change anything. Don't go finance a car, heaven forbid. Don't move a bunch of savings onto a debt. Don't do anything that might change the circumstances of your pre-approval without talking to your mortgage broker. Make sure that you don't make any dramatic money moves until you've got clearance from a mortgage broker, because that can put your approval at risk.
Very good point.
And you might be facing a rejection unnecessarily. And then secondly, from the counselor's perspective, look back at your spending plan. A mortgage broker is going to give you the top number that you would be approved for. Now, look at your cash flow and decide, is that what I really want to spend? Because sometimes what happens is we go right to the tippy top of what we're approved for, and then we end up being what's called house poor. And the cost of managing our home and maintaining our home eats up so much of our income that we're not able to enjoy the other parts of life, the other things that we really value. So decide what you actually want to spend on a home versus what you're approved for.
Right, makes a lot of sense. All right, so we're at the point now, pre-approved, we have this nice chunk of money that we think we can spend. We found the home of our dreams. We want to buy this house. So let's talk about down payment now. What kinds of things do people need to consider and understand when it comes to down payment?
Well, similar to, how much do I want to spend, that's going to determine how much of a down payment you need. In Canada, for your primary residence, you need at least a 5% down payment. And if you have a down payment that's between 5% and 20%, you're going to have to pay what's called mortgage default insurance. So that might affect, how much do I want to spend because I'm going to have to pay this insurance on top of that. And so those are the things that you want to be able to go in with, knowing, okay, if I put 10% down, my mortgage default insurance will be a little bit less.
Okay. And so let's say people want to start saving now for that down payment. What kind of things do they need to consider when saving?
It's a great idea to determine where you want to save your down payment. Saving it somewhere that you can leverage interest on your own, to your own benefit would be really important. So using a vehicle that's an investment vehicle like the RRSP or the FHSA is a great idea. Some young Canadians are using their TFSA so that they can invest and grow their down payment, or just a high interest savings account.